Hello everyone. In this video, we'll discuss about how to check if the promoters or managers of a company are allocating the capital wisely. Now, you must have seen in most of my videos that I have been talking quite a lot, about this particular concept of capital allocation. And one of the key tenets that I mentioned in one of my previous videos that one should only invest in those companies where the management is rational. So basically, when we say that management is rational, it all boils down to this particular concept of capital allocation. So what exactly do we mean by this term called capital allocation is something that we are going to really that we are going to discuss about in this particular video, and why this entire concept of capital allocation is so important for investors like Warren Buffett and Charlie Munger, why they are so much obsessed, or why they are fixated on this particular concept of capital allocation. So we'll look so we are going to answer all about that in this particular video. So before we get into the details, or before we check whether the managers or the CEOs are allocating the capital wisely in a business, first we need to understand few key terms that are important in this aspect, and those are weighted average cost of capital, which is basically represented by WACC, or also known as WACC, and the second one is return on capital employed, or also called ROCE. So WACC is basically nothing but the bare minimum or the cost of capital that an owner has to pay for deploying capital in a business. Now we know that every business there has to be some capital which needs to be deployed for funding those assets, right? So as we have seen in one of our videos wherein I spoke about the balance sheet, and how balance sheet reflects the healthiness of a business, like how a business is being funded. So what are the capital structure of that business, how the assets in a business are particularly funded in that, right? So that is what it talks about, that assets equal to liabilities plus equity. So the right hand side is basically the capital, that is whether the assets are being funded by taking loans, or whether the assets are funded by through equity part. So the right hand side of that equation talks about the capital which is being employed in the business. So now at what cost that capital has come, right? So what is the cost of that particular capital is nothing but the cost of capital, or to be more specific, weighted average cost of capital. So just to repeat once again, it is the cost that an owner is paying for deploying capital in the business. So it is as simple as that. Coming to ROCE, which is return on capital employed, it is defined as the earnings before interest and taxes, which is also called EBIT, divided by capital employed, right? So I think it is straightforward. So now to check whether the business, or whether the managers are creating value for the shareholders or not, one of the litmus test can is that you can see whether the ROCE, or the return on capital employed, is greater than WACC, and if it is there, that is what point number 3 says, that good businesses have ROCE which is greater than WACC, and it is this difference, or this little extra, or it is a difference between ROCE minus WACC. So it is that the extra part which creates value for the shareholders, right? So bare minimum, let's say if a company has a weighted average cost of capital 15, and if ROCE is, let's say, 16, so it is this 1% which will create value. So although it is not as great as if it, so ideally it should be higher, it should be higher, the better part. So if ROCE is greater than WACC, then you can say that that the managers, or the promoters of a company are allocating the capital sensibly, right? And vice versa, that poor businesses have WACC which is greater than ROCE. So basically, if my cost of capital is more than my returns, obviously the value, or the shareholders value, is going to get eroded over a period of time, right? And that is what it is. It says that poor businesses have weighted average cost of capital which is more than the return on capital employed, which thereby results in frequent capital infusion to the business. And this again results in either equity dilution or taking debt, and which are both are detrimental to the business. And the reason is, I mean, it is similar, same, right? I mean, it is very simple, that if my cost of capital, so if I'm paying more than the returns I'm generating on that capital, obviously it is not good for me or for my shareholders as well. And if I'm generating more on the capital as compared to the cost that I'm paying for that capital, then obviously whatever the premium or the alpha that I'm generating for the shareholders, that is going to create value for them over a long period of time. And thus the last point says is that if a company grows without excess returns, again, if so we may see that there are companies where the top line or the revenues growing consistently year on year, but then if the returns or the return on capital employed is not more than the cost of capital, then that growth does not create any value for the shareholders, right? So again, we need to see that we should not only focus on the revenue growth, we should also focus on at what cost that particular growth is coming. And if that cost of capital is more than the returns on that capital, then that growth doesn't have any value. Rather, it will erode the value of that particular business very fast. Now, in this particular slide, I'll talk about the capital allocation toolkit, right? So in the previous slide, what we discussed, that was only one aspect of, it is not, it does not give you the entire picture of capital allocation, but then it is one of the, it is one of the many aspects of checking whether the management is, allocating capital sensibly in a business or not. So to give you the entire end-to-end picture, I have basically drawn this diagram and it is very quite simple one and also self-explanatory that there are rather three methods of raising capital in a business. So every business requires capital, as as I had mentioned earlier as well. So if we want to raise capital for a particular business, there are three modes of three methods of raising the capital. One could be the internal accruals, that is whatever the capital the business is generating, we can instead of giving out dividends and all, we can put it back to the business. So that is what it calls for, internal accruals. There is also one more method, simply that if we can issue debt by taking loan from the bank or by issuing bonds, corporate bonds and so on and so forth. Those, that is the second method of issuing debt. And the third is that we can just give the equity and raise the capital. So again, these are three methods by which one can raise the, or by which one can the business can raise capital, and for business can raise capital for the particular assets, for funding some assets. Now, coming to the right hand side of this slide, which is basically the capital deployment, and this is where the entire capital allocation skills of a particular company, managers of a company, or the skills are being they get checked. So whether the decisions, whatever the decisions they take with the capital, do they make sense or not. So this is broadly the five avenues, you can say, that where the capital gets deployed. And Warren Buffett and Charlie Munger, they are very much they're very much strict about these particular criteria, that so how they check the rationality of a management is by just looking at what these people, or what these CEOs and the managers do. What do so where do they deploy the capital in the for in a particular business, right? So broadly, there are five avenues, as I mentioned, for deploying the capital. So first could be that you can invest your excess capital. Again, this is excess capital that I'm talking about. So you can invest back the excess free cash flow back into the business. And this is also called as organic growth. Like if so like companies like so usually growth companies, which which have a lot of growth potential ahead in the times to come. So usually companies like DMart, so they do not usually pay more of dividend, but then they take all the profits and excess free cash flows, and they put it back to the business. So that is called that. So that is one way of deploying a capital. That is, you invest back the particular capital into the business, which is also called as organic growth. Now, second point is that with that excess free cash flow that you have, you can also buy growth, or buy, you can buy other businesses as well. So we have seen that companies like Motherson Sumi and all, so they are very much into inorganic growth. Like they buy any of the they buy most of the distressed companies which are working in auto ancillaries sector. So but you can buy growth in that way as well. And third is that if you have excess free cash flow and you do not and if the managers don't they don't have much opportunities either to put it back into the business or buying other businesses, so they have an option that they can simply give the dividend, or sometimes they can even raise the dividends as well, right? So example could be like ITC, wherein they, if they feel that they don't have much opportunity for the excess free cash flow to invest it back to the business, or if there is no inorganic growth available to them, which is sensible, so they can just issue the dividends and all. So that is how that is the third way of deploying the excess free cash flow, or deploying the capital. Fourth one is very important. You can just pay down the debt. So most of the companies, when they have when they have huge debt on their balance sheets, and if they have good free cash flows, consistent free cash flows, so one of the sensible actions could be is that you can pay down your debt, because debt, we know that debt is very dangerous when the economic cycle turns down, or if they're not favorable, if the conditions are not as conducive for doing a business, then debt can be very detrimental to the business. So one of the sensible this thing could be that you can pay down your debt as well. And the last one is share buyback or share repurchases. And I think it is, and I think most of the companies now they dwell into this share buybacks or share purchases. That if so again, so all these five criteria based on how they can tell you a lot about management. So how the management is faring, how the management is faring on the front of capital allocation. All these five criteria can help you out to determine whether the management is rational or not, because and it is very important to see all these parameters, because let's talk about, let's say, share repurchases. Now we have seen that most of the companies, they have they resort to share buybacks, but then it is not important every time that share buyback creates a value, right? So it can be detrimental to the value of a share. It can be detrimental to the business if a share buyback is done at a very much at a very high price. And similarly, other things as well, that if I'm paying if I'm buying other business, but then if I'm paying more for that, then again it is not a good capital allocation decision that I have taken, right? So basically the key fundamental is that what these investors, especially this investors like Warren Buffett and Charlie Munger, they focus, they are obsessed with this entire concept of capital allocation, and they only so Berkshire only invest in those, or buys out only those businesses where the managers have been extraordinary about this entire concept of capital allocation. This is what the capital allocation in a nutshell is all about. So to sum up this presentation, the two key pointers which Warren Buffett and Charlie Munger keenly believes in is that capital allocation is, in that case, is an investment, and as a result, all the CEOs are capital allocators. And I think we have seen why this particular statement holds true. And also, one of the important roles a CEO should have is this particular concept of capital allocation. So, guys, this was all about capital allocation in a nutshell. So, if you have any doubts, if you have any comments, any feedback for this particular video, any queries, if you have, just you can drop a note, or you can you can comment in the comment section, and I'll be happy to help you out. So that's all for today. Thank you and have a nice day.